So today we have a really fun video. In yesterday's video already I showed a portfolio strategy. Instead of investing in the S&P 500, we simply pick every single year the top 5 market cap stocks. So we go to any site such as company's market cap or so, and pull out the five companies with the biggest market cap, like Apple, Microsoft, Nvidia, Alphabet, Amazon, currently in 2024, and we equally distribute our new money. We invest, say, 10K every single year. We equally invest, so 2K into each position, right? And then we just buy the position and hold it forever. And this strategy is really simple. It's a straightforward strategy. I mean, it's not always winning, but it seems very interesting. And in the last 10 years, it has smoked the S&P 500. So we have seen a more than 20% compound annual growth rate of this strategy. I'm not sure the exact number, but it was something north of 20%. And of course, this will not always deliver 20% returns, but the idea is simple. So we invest in the best companies on the planet, buy and hold them forever. And our bet is that this company, and we don't never sell, which basically means we minimize transaction costs, we minimize holding costs, because holding a stock is free. You can simply hold a stock in any brokerage account for free. We let it compound. So we buy those huge companies that usually have the ability to compound money. So if they make money, they can spend the money efficiently to increase earnings per share, which means the company value compounds, and we can buy those compounders, long-term compounders, and hold them forever. And you don't want to hold a bad company forever, right? Because the bad company will go bankrupt eventually. But very rarely will such a big, huge player go bankrupt. And that's why this basic strategy has worked so well in the past. And now the question is, will it work in the future? I got some comments in the last video. Like one comment was, this strategy might have worked in the last 10 years, but will it work in the next 10 years? I doubt so. And of course, this is a question. I mean, nobody knows. It's not investment advice. On this channel, I don't give any investment advice. I just analyze some data. This was a back testing exercise yesterday. It worked in the last 10 years. I bet it will work. So my bet would be it will work in the next 10 years as well, because we see huge winner takes most dynamics in the AI industry. And there are also economical reasons why the winner takes most. Those have the highest, the biggest brand recognition, the biggest network effects, the best research and development, which is everything in the area of AI, right? They can invest into, say, compute clusters to create AIs, and small companies cannot do it as efficiently. The unit costs are usually cheapest with the large companies, because the large companies can spend more on research and development and optimizing the production processes, and so on, right? So we have Lindy effects and all these kind of good factors that basically increase the odds of one of the winners to remain the winner. So there's usually this momentum going on. If you are already a winner, there's momentum that you keep winning. And basically this strategy simply bets on this, on the winners, and let them ride forever. And we let 1,000 flowers bloom, so we never cut any flowers, we never cut any weed. We just hope that the weed might become a flower, or if not, become irrelevant in the portfolio. And if you look at these portfolios, so here this is one of the portfolio in the years. Basically, I wrote a script. I wrote a script in order to address this comment that I kind of picked a time period where it worked nicely between 2014 and 2024, but it might not work in the future. So I created this script where I can basically put in any start year and any end year and try out the strategy, right? And this is the script. I just finished it, so I thought, okay, now I present it to you. We can try different inputs into the script. Okay, first let's try the year 1990 to 2000, so 10 short years between 1990 and 2000. 2000 we had this huge bust in internet stocks. You can see here the portfolio value would be 43% Citigroup. C is like Citigroup, and Citigroup has had a significant run back in the 90s, also beginning of 2000s. Then it crashed badly, right? So I mean, this is a threat as well, of course, if you're overweight. But hopefully, if we let this run for a long period of time, other companies will take their spots. It's always like an 80-20 distribution, right? Always a small minority of companies actually overcompensate the large companies. So we have made our bets in those companies like Microsoft, and this 3.9% in the year 2000 will become a huge percentage, as we will see later, in the year 2024, right? If you keep those riding, if you never cut these flowers, and if you maintain the positions by actually adding to the Microsoft position if Microsoft reappears in the top 5 market cap list. And basically, for preparation, I created this spreadsheet. So for every single year, I simply wrote down the 5 companies that have been in the top market cap companies. So we see a lot of ExxonMobil in the 90s. We see a lot of Microsoft in the 2000s. ExxonMobil came back in the 2010s, kind of. And then we see Apple, Amazon, Alphabet in the later years. And in the year 2000, we also see like Microsoft's, Apple's, Alphabet's, and so on. And we might see like Nvidia's, right, or so in the next kind of decade. Nvidia being the leader for another decade or so. So let's see. So this was the preparation I did for this script, and I wrote the script. And now we can try any combination. So let's do it. Here I tried between the year 1990 to 2000. We can see this C position, this green position here, grew significantly here. It has already, like, only this one single position has actually grown faster than the S&P 500. So if you invested, so this is based only on 10% of our annual contributions, right? So we put 10% of our annual contributions into each position, 20%, sorry, 20% into each position. If Citigroup appears, so Citigroup in the year 1990, is it Citigroup? Where did it appear? Maybe no, it pulled the data. It pulled the top market cap data. Citigroup. So let's maybe have a look at Citigroup. Where is it? Okay, so now I cannot find the data. Yeah, okay. Okay, this is interesting. So, okay, here you see it. Here you see the chart. Citigroup. It's just as an example, just the example. We don't need to dive into each and every position because it's a portfolio. It's an automatic portfolio algorithm, right? But just to see some example, Citigroup now is a $125 billion company. So it's a huge company. But you see the stock is pretty down here, right? It's like only $65 or so. Actually, in the 90s, it had like a third. So the one stock cost like $22, probably split adjusted, right? So the stock price was 1/3 on the market cap probably as well. So it was like market cap was 1/3 of this, like 40 billion or so. In the 90s was a huge company. It was already one of the biggest companies, and then it grew significantly. So it grew to huge amounts, like $500 per position or so. So it was like 10 times larger even. It was. If it would still be 10 times larger, it would be a $1 trillion company, right? It would be one of the biggest companies on the planet. But then it had this huge crash here in 2008, towards 2008, almost went bankrupt, and then it kind of never recovered to the old highs. This is also a threat, right? If you own fewer positions, something like this could happen and harm your portfolio over time. Good. Okay. So, but anyway, you see the S&P 500 was like returning after 10 years of following this strategy. In the S&P 500, you would have had 141K. In our strategy, you would have had 435K. Okay. So this strategy also between 1990 and 2000 would have outperformed the S&P 500. And if we increase the time frame, so say we go from 1990 to 2010. So now we have 20 years of compounding. Let's see how this fared. So now it would be worse probably, right? If you remember this position here, this one is a Citigroup position. It crashed in 2008, right? So it crashed to almost zero, and this was probably our biggest position. So this is like kind of the worst case that actually could happen to our portfolio, that one of the winners that we invested a lot of money in actually crashed to almost zero, right? So now the Citigroup position has actually crashed to only 6% of our portfolio. ExxonMobil is now the biggest part of our portfolio, but still you would see this, our portfolio strategy would outperform the S&P 500. So even though we had a significant crash of Citigroup here, the overall portfolio, it also took a huge hit, but we always are on top of the S&P 500 for those kind of instances. For sure, you will find some combinations of decades, also a combination of years, where the S&P 500 was better, right? So this just has to happen, right? It's like that no strategy always beats the S&P 500, but this strategy also like seems reasonable. It seems to beat it often enough, right? And if you increase the time frame, usually if you increase the time frame to say between 1990 and 2020, this is like not as optimistic as I could be, right? Because in the last 4 years, we have seen a huge growth of our top 5 positions. They have outperformed the S&P 500. So if we managed to stay on top for this combination of years, then of course we would stay on top if we add 4 more years to 2024, because the last 4 years were such great years for our strategy as well. And so now we have like 30 full years. Let's see, I'm really curious now if 30 years is also outperforming. Now you see Microsoft becoming our biggest position, because in 30 years Microsoft is always reappearing in the top 5 companies, right? So you see Microsoft in the 2000s, we see Microsoft in the 2010s. Now I need to prove, right? So here we see Microsoft in the 2010s. Again, Microsoft. We see Microsoft in the 2020s, always keeping one of the main positions in the stock. So every single year we basically accumulate more Microsoft shares, and also we let the existing shares we have compound, because we never sell any share, right? Remember, the number of positions in our portfolio grows significantly because any of those positions could eventually come back or so. So we basically de-risk our strategy by letting them compound, by keeping those smaller positions as well, because those smaller positions, Microsoft was such a smaller positions, they might come back and become huge positions of our portfolio. And yeah, so I think it's a nice strategy. Again, you see our portfolio outperformed S&P 500. Of course, we could now choose different starting dates, different end dates, could do a full-fledged study, but you can see that even if from time to time we choose some bad stocks like Citigroup, even as main part of our portfolio, which is kind of, again, the worst case that could happen, we chose a huge stock that crashed 90%, and this stock was the primary stock in our portfolio, the main stock, our main holding, like a huge percentage allocation of our portfolio. Still, we outperformed the S&P 500, which is kind of very interesting over a long period of time, over 30 years, right? So usually you say, okay, after 30 years, anything that outperforms the S&P 500 relatively consistently, and I say not consistently, but in a probability wise, in like many 30-year periods, is actually a good strategy. Okay, now let's have the maximum period I can with the data I have. So I showed you the data I collected, and I wrote the script, and I can only go back to 1990 for now. This is what I've done the whole day. So this could be extended. We can make a study out of it, see if it also applies in 1960 or so. If we start in 1960 and it's right, doing like a full-fledged study. I'm not like a researcher, I'm a hobbyist, I'm a retail investor that does these kind of things. Okay, now we have the maximum period between 1990 and year 2024. So this is 34 years, it's almost a lifetime of investing. And let's see how this strategy performs. Here we see Microsoft position has grown significantly because in recent years Microsoft has compounded very well, and we always buy back more Microsoft. But probably our buying back Microsoft becomes irrelevant because the Microsoft position is already so huge. Our end portfolio value is, after 34 years, like 2.2 million versus 1.7 million S&P 500. So we again beat the S&P 500 and significantly, right? With a simpler strategy that is, and often the problem with those kind of strategies that beat the S&P 500 is that you cannot implement them because they involve too much trading, right? Oftentimes it involves, say, buying 100 stocks that are 100 value stocks or something like this, right? So but you cannot really buy 100 stocks or you pay too much transaction fees. It's also for a smaller portfolio amounts, you cannot really buy 100 stocks because sometimes the stocks just cost $1,000, right? And if you want to allocate $500, you cannot even buy a single stock. Like if one position would be $500 or so, you can't even buy a single stock because the stock is too expensive. So you would have to buy fractional shares and so on, which is possible for some, but it's kind of all of this is maintenance overhead. It's difficult to do and it's very expensive. Even if you can do it with fractional shares and stuff, it's impossible to do because of the management overhead, because of the transaction fees, and because of the tax burden you have. Because if you buy and sell positions, on the selling you have to pay capital gains taxes, and paying capital gains taxes is very inefficient. You want to compound your money. You don't want to tax, pay intermediary taxes. If you want to pay taxes, then once at the end of the compounding period, you want to before you pay the taxes, you first want to also compound the tax money, right? And after that, you can, in the end, you can pay the taxes. But in the meantime, your saved tax money basically has compounded and has created value for you. So that's why this compounding is actually working in our favor using this strategy. It's also very simple. It's low effort, low maintenance overhead. We just buy 5 positions in the beginning of each year, and then don't worry about not even look at our portfolio the whole year. We can focus on the work or creating value. And we are on the right side of change because if a company like Nvidia comes up here, like the red one, we basically buy the company, right? We buy the company, and if Nvidia will be the winner during the next 10 years, we will see significant gains, and the Nvidia position will grow in our portfolio. So we always consistently buy not only the winners, the best companies on the planet, but also the companies that can maintain their leadership. Because here, if you see Microsoft appears 4 years in 4 out of 4 years in the top 5 companies, you basically buy Microsoft 4 times. In each of those years, you buy Microsoft. In each of those years, we buy Apple. So we basically not only buying Apple once, we buy it multiple times. So we also, the strategy also rewards a company that can consistently maintain its leadership. And over time, we are basically optimizing our portfolio towards the companies that can maintain leadership for a long period of time, which is exactly what we want. Okay, so I think this was a very interesting position. It was a lot of fun for me. Thanks for the comments as well, because those comments kind of challenged me to do more work. I did no more work. I wrote the script so I can put any kind of time period there, and I tried different time period. Strategy seems to be winning regardless. Of course, probably if you would try different numbers, then you might come up with some periods where the S&P 500 won. But I think, anyways, could be an interesting strategy to deploy. And if you want to also be on the right side of change, focus. I said follow a simple investment strategy, passive investment strategy, and then focus on making more money. Because if you make more money, you can actually put more into the investments. And for this part, we have the Finxter Academy. So go to academy.finxter.com, finxter.com. Check out our newest course, the Ultimate Gemini API course for upcoming AI engineers. It sounds complex, but it's really simple stuff like calling the API. You don't need to, if you are an AI engineer, you are basically using the AI. You are not programming the AI. You are not actually doing AI research or these complicated things. You don't need to understand the math. You just need to understand basic Python code to call the API, call the functions in order to access the leverage provided by AI. So you can actually scale up, build multi-agent teams and systems, for instance with Langgraph, or using Hugging Face to create large language models on your local machine, privacy-aware machines. And these kind of skills allow us to leverage intelligence, to scale intelligence indefinitely, and deploy this intelligence in real-world business systems to create value for those businesses, for the winning businesses, right? Those one and others, to create value for those businesses and create value for ourselves. Because if we remain valuable people in the marketplace, we remain sought after resource in the next decade or decades, and we can take the money and reinvest the money into those winner companies to be on the right side of change. So this is the basic strategy. Thanks for being an active listener to the Thinkster channel. I would appreciate if you could give us a like and subscribe to the channel. I'm really glad. I really appreciate just to have you here, to have your attention, and yeah, I hope you stay with us and tune in tomorrow. Bye.